Hello everyone, welcome to the Audit and Attestation class. In this class, we'll be understanding in detail about Sarbanes Oxley Act Title 2, which is Auditor Independence. We'll be understanding in detail all the subtitles starting from 201 to 209. And this class is in continuation with the SOX Part 1. So please go through Part 1 as well before diving into this chapter. So far we have covered Title 1 of the SOX 2002, right? Just take a quick look what all things we have covered in Title 1. Title 1 have anything and everything relating to PCOB. So establishment of PCOB, power of the PCOB, registration of the PCOB, or you can say quality control standard of the PCOB and quality control standard which they are testing for the firm which is being registered with the PCOB, inspection procedure with the of the CPA firm, investigation and disciplinary proceedings against the firm, foreign public accounting firm, commission oversights, accounting standard, and the funding requirement of the PCOB, right? So this is all in Title 1, right? Now we are coming to Title 2. Title 2 is more related to the auditor independence, right? It has, you will see like a lot of things are overlapping with the independence rule which we have studied in last class. So SOX 2001. So section is being defined based on the title. So if you have seen the Title 1, the SOX 101 to 109 was there, right? And now we are coming to Title 2. So here you will see SOX 201 to 209. So again, here also 9 section we have, right?
So sir, do we like require to learn these areas section wise?
Yes, probably for the examination purpose. They will ask you from like which title this provision is, or from which section of the SOX this provision is. They may ask you that kind of multiple choice question. So that's the reason I specifically mention the sections here, because otherwise if you see like throughout our books we do not mention one section and stuff, but here if you see in your multiple choice question you'll see certain questions around those.
So that is more from first 4 titles which you mentioned, important from exam point.
Yes.
Okay.
Yes. So you will not see any question out of this.
Okay.
Few section you need to mug up. Yeah.
Okay.
SOX 201. Service outside the scope of practice of auditor. Right. So what are the services you can do and what are the services you cannot do outside the scope of an auditor? So as an auditor, you can provide certain non-audit services, but not all the non-audit services, right? Same way how we have learned in independence rule. So the non-audit services general rule is prohibited, right? So same way here also the same rules applies. The non-audit service, which is like bookkeeping services, maintenance of accounting record, financial information, design and implementation of internal control, appraisals, valuation services, actuarial services, internal audit service, management or HR function services, broker, dealer, investment advisor, investment banking services, legal expert services, lawyer services. So also such services, general rule is prohibited, right? But there are certain exceptions to the general rule, which is being mentioned in the independence rules also of the AICPA. So you need to follow those independence rules for the exception. But whatsoever the exception you are taking, it's mandatory required pre-approval of the audit committee, right? So you can provide non-audit services which are exempt from the prohibition, but you need to take the approval from the audit committee or the listed company that you are providing this services and you are charging this much amount of fees for these respective services, right? So you need to take a pre-approval for any non-audit service you want to provide to the listed client, right? Second is non-audit service are allowed with the pre-approval from audit committee or exempt from PCO, which is like again independence. And
And
yes.
here, as you mentioned, we have to take approval. So
Hmm.
this is from standpoint of companies performing a stat audit or just performing SOX.
Yeah, that's a good point. So when you are doing the audit of a listed company, you are mandatorily need to report on ICFR, internal control over financial report, so that your report will be integrated report, not only the financial statement audit report. So for issuer, it's an optional that you can give financial statement audit report or you can give an integrated audit report. But for listed client, it is mandatory to provide integrated audit report. So integrated audit report, in that you'll be giving opinion on the financial statement, and also you'll be giving the opinion on the internal control, design and operating effectiveness of the internal control as well.
And what if a company is just from internal audit standpoint is just working on the SOX for a
Mhm.
particular engagement? Then are there can they provide other auditing services, or in that case also they have to take the approval and stuff?
We are saying like we are working for any company as an internal auditor, right? That's what you're saying, right? So
Yeah.
if you are working as an internal auditor, you are reporting to the management. So there's no independence requirement,
Okay. Okay. Yeah.
right?
Okay.
In
Got
that case of scenario, you can provide non-audit service comfortably.
it. Okay. Fine.
Very good question, Gurmeer. Next one is 2002, 202, SOX 202. SOX 202 is pre-approval requirement. All audit or non-audit service must be pre-approved by the audit committee. Especially for the listed company, it is a general rule, whether you are providing audit service or non-audit service, both need to be pre-approved from the audit committee. Pre-approval requirement for non-audit service is waived off. So exception to the general rule. When and why? When your total revenue from the non-audit service is less than 5%, right? For example, if let's say you are charging $100,000 to provide audit service of any client, right? And during the audit, you come to know with any accounting matter which company is not following properly, and you have given an advice to the company, or you have issued a white paper to the company and you have charged, let's say, $2,000 for that, right? For the $2,000, which is less than 5% of your total revenue. Now your total revenue is $102,000. And if it is less than $5,000 or $5,100, then it is not required to have pre-approval of the audit committee. Then it is fine. Second is rectification by post-approval. For example, you are conducting the audit and you have found the company has not complied with, let's say, ASC 606, 842, or 326. So these are new accounting standard which came in last 3 years in USA, right? And the company accountant is an old school accountant. He does not know ASC 606, 842, and 326. And when you have conducted the audit, you come across all this non-compliance, and then you requested that we can provide these services to you to look at all your previous contracts relating to your revenues and to your leasing and to your credit, right? And we can provide you the suggestion, or you can say recommendation or consultancy, and we'll charge, let's say, $20,000. So your audit fees is $100,000, and for this consulting service of accounting matter, you have quoted them $20,000. And when you are conducting the audit, you have already performed the review of all these contracts, right? You have already done with the 60% or 70% of your work. Only you need to make a formal white paper and submit to the client. That is the additional work required, right? And then you have made the white paper and submit to the client, and you have given the bill of $20,000. But that bill also can be get a rectification post approval from the audit committee. So if audit committee do the post approval of the services provided by the auditor, then also it is fine, but it has to be before signing the audit report, right? It should not be like after signing the audit report, you're going back to the audit committee to do the rectification. So rectification is possible, but before signing of the financial statement and audit report. Make sense?
So can you clear this point again? So I missed, I guess, in between.
B point even
Point
I
B.
didn't understand properly.
One by one. Let me present a white screen. And we can, yes, tell me what all are your doubts, so that in one go I can help.
Point B did not understood, sir.
Okay, any other doubt?
Same here, sir.
Same here. Okay. So here, let's say the financial year 2021, that is for Jan to December, right? And you are giving audit report, let's say on February 28 audit report for this financial year, right? So you have started audit of this listed company. Let's say you are doing interim audit here in September, right? So when you're conducting interim audit, you find the company is not in compliance with ASC 606, 842 and 326, so which are new accounting standard codification in US GAAP, right? Because like audit accountant is of old school accountant, he does not know much about application of this new accounting standard, right? And in this interim audit of this 9 months, you have already reviewed the contract, right? And you have already summarized the details, right? And now, because for your audit purpose, if you have any disagreement, then also you will be doing this work, right? For example, if you are saying the revenue of the company is, let's say, $1 million as per ASC 606, let's say it should be $600,000 instead of 1 million, and there is a difference of $400,000, which is material to the financial statement, right? This $400,000 instead of revenue, it has to go into, let's say, unearned revenue, right? So this is a disagreement in any which ways you have identified. So how you have identified? You have reviewed all the contract, you have summarized everything, right? Now you are saying to the management, we can help you in doing the correction of your accounting, right? But for that, we'll be charging the accounting consulting services fee of $20,000, right? So here, let's say in the month of October, you and management sit together and had a meeting, and you said there is a disagreement of 400,000, and all the accounting relating to this new standard which you have done is not right. We have done all the work and we have come up with the summary, and if you allow us, we can provide you in completing your accounting, or in guide you in giving the appropriate accounting, and we'll be issuing you the white paper. Then how to do the accounting of the respective contracts of revenue, lease, and your credit rating. And for that, we'll be charging $20,000. So this service was, you were not aware of at the time of January when you have accepted the engagement. At that point of time, you might have taken the approval of audit service only, right? Make sense? Yes, no? Are you guys with me so far?
Yes.
Yeah, yes,
Right?
sir, yes.
And now you and management in the month of October have agreed for this consulting service for $20,000, right? Your audit fees is how much? $100,000, and this 20,000 is 20%, that is more than 5%. So you are supposed to take pre-approval, but you cannot go back to the January, right? Because the situation arises in the month of September and October when you have actually conducted the audit. So in that case of scenario, before filing, You from October to February period, any time here, you can take approval of the audit committee for providing this consulting service at $20,000. That is allowed. Make sense?
So in that case, PCOB will be expecting certain kind of justification.
No,
from
it has
the,
nothing to do with PCOB.
sorry. But we have to provide some certain kind of justification also, right? That
No, like
we were not able to.
once you have conducted the audit, once you have signed off for next year when you are registering or re-registering or updating your registration with the PCOB, then you'll be providing this much amount of audit fees we have taken and this much of consulting services we have taken.
Okay.
The approval part is only has to be taken for the management. There's nothing involvement from SEC or PCOB, right?
No, SEC and PCOB says you need to take pre-approval from the audit committee. Why audit committee? Because majority of the members in audit committee are independent director.
Okay. Okay. So that in that case, where rectification is done, so approval can be taken from that window, October to February
Yes.
28th.
Yes, yes, yes.
And
But
is there any?
not
Okay.
after 28th of February.
But like, is it like first you have to take approval, then provide service, or like if in case we provided that service from October to December, and we're taking approval in the month of January, that's okay. There's no issue on that.
That's allowed. That's allowed.
Okay.
Because like whenever company do have audit committee meeting, that point of time they will put in this item in agenda, right?
Okay. So then in that case, I guess it becomes more of an acknowledgement.
Administrative, yeah, administrative requirement. Yes.
Okay.
Because like audit committee is meeting happen quarterly, right? But you need to assess this situation right now. Otherwise, you'll be delayed in preparation of the financial statement. Right.
Okay.
For example, you are conducting the interim audit in September and October. So next audit committee meeting, let's say, is planned in the month of February. Right. If you have not taken any approval, then you will not be providing the services. If you're not providing service, company accounts will not be complete. Company accounts will not be complete. What you will be conducting in the final audit and how you will be issuing the audit report. So these all are practical reasons why this is a relaxation in the rule.
Okay.
Right?
Okay,
Make
okay.
sense?
It's a
Okay, so this is SOX 202 and disclose pre-approval of non-audit services to the investor. That means all the non-audit services which you are providing need to be disclosed to the investor also. So in your MDA section, so their company providing the disclosure of all the audit services and audit fees they are paying and all non-audit services they are taking from the CPA. That is also part of your MDA. So that goes in 10K. So in 10K, it's being mandatory requirement to submit audit services and non-audit services, audit fees and non-audit fees disclosure. Next is SOX 2003, audit partner rotation. So every 5 years, right? Simple and straightforward rule for audit partner only. So in US, audit firm rotation is not mandatory, but for listed company, every 5 years, their engagement partner is mandatory to rotate. Only for the listed company. In India, like Companies Act 2013 says, audit firm need to be rotated every 5 years. Whereas in US, audit firm is not mandatory to rotate, but only audit partner rotation is required. And that is only and only for the listed company. Right? Make sense?
Yes, sir.
Next is 204, SOX 204, auditor report to audit committee. So whom the auditor report for the listed company to audit committee, and for non-listed company whom they report?
Board of directors.
Board of director or those charged with governance, right? And what all things mandatorily required in the audit report? One is CAN. So this is this came in 2020 only. So CAM is called critical audit matter. You know what is critical audit matter?
So those matter generally which contains any significant risk and might impact the judgment of the readers of the financial statement, like going concern, revenue recognition. Most of these stuff are critical audit matters. We have to also mention in the audit report what kind of procedure we have dealt with in the critical audit matters and everything.
Absolutely true. Absolutely true. Anyone else would like to add to Ankush?
No, sir.
So Ankush has explained clearly. Yeah, no, rightly said, Ankush. Here, sometime like CPA get confused. What all things I should report and what all things I should not report. And sometimes they make it the process very lengthy and inefficient, which is not required. So here, what all things you need to keep in mind when you are doing the risk assessment for any company? What all areas you have identified as a fraud risk or significant risk area? So those are generally, you can say, critical audit area. That is the reason you have assessed the risk high, right? It's not mandatory all the time, like maybe the fraud risk or maybe the going concern or maybe the provisions or maybe the litigation would be the critical audit matter. It is on those area where you have identified as a high risk area, which you have identified as a you can say risk of fraud could be possible, which you have identified as a significant risk area, and you have performed additional audit procedure in those area considering the risk at that respective area is high, right? All you can say CPA most of the time get confused which area do we consider as a significant risk area and which area we can consider as a fraud risk area and which area we need to test additional information, right? This is very, very critical judgment that a CPA need to form, and this is very, very critical area that you can say a CPA probably require consultation as well internally, right? So for example, let's say you can say for in case of sales, let's say you have identified the risk of fraud or management overriding of controls, right? In that case of scenario, you have intuition that management would be increasing the sales to mitigate their target, and if they are mitigating their target, then the CEO, CFO, sales head, marketing head, they'll be getting like additional bonus and incentives, right? And you have identified sales as a fraud risk area, and you have planned a lot of additional audit procedure around that respective area. And sometimes those area, when you are conducting the audit and you have found any fraud and you have found any additional risk, for example, let's say during the year company has done a new acquisition, right? That may be a complex accounting matter. For example, your company has, let's say, the valuation of, let's say, $1 billion, and you have acquired another company with, let's say, $600 million, right? That's a significant acquisition you have made during the year. And that acquisition, there are a lot of complex accounting matters like transfer of employee benefits, transfer of litigation, right? Geographical location, different accounting. For example, you are doing accounting on SAP, and that company which you have acquired, they are doing accounting on, let's say, Oracle, or they might be doing an accounting on NetSuite or QuickBook, right? So those all acquisition might be a complex accounting matter, right? And that you have considered as a critical audit matter. So here in your audit report, you need to clearly mention what all area you have considered as a critical audit matter, right? And like it has been mandatory for a CPA to have at least 1 or 2 critical audit matter. If you do not have any critical audit matter, then you need to give the reason why you have not identified any critical audit matter in your audit report, right? So this is mandatory requirement since from 2020 on all the audit report of the issuer to report on the critical audit matter. So again, like same way like how Ankush said, so in critical audit matter, you need to define three things. One is what area you have identified as a critical audit matter. Second, what all procedures you have performed and how comfortable you are on those by performing those audit procedures. So these all information you need to provide in a separate section, which is called critical audit matter section in your audit report. Right? Make sense?
Yes, sir. Sir, SAD means summary of adjusted differences, sir.
Not necessarily. Not necessarily.
Then what is SAD, sir? Full form.
Sorry?
Full form of SAD, sir.
Okay, SAD. So you reached to this point. I'm still at first point. Sorry.
Okay.
I thought you were saying like critical audit matter or SAD. Yeah, summary of adjusted differences. Yes. So second point, alternative treatment within the gap discussed with the management and preferred by CPA firm over the treatment chosen by the management. For example, let's say for inventory. For US GAAP in inventory, weighted average method is also allowed, FIFO method is also allowed, and LIFO method is also allowed, right? Let's say company has chosen the LIFO method, but you recommend company that FIFO method is more better presentation of the financial statement and the inventory valuation, right? In that case of scenario, the company has chosen the allowed method as per GAAP, but you have different view, right? That also you can report in your audit report. Alternate treatment allowed within the GAAP, right? So company is choosing LIFO, but you are recommending them FIFO, and what are the reasons why you are recommending them FIFO? That also can be mentioned in your audit report. Third is other material written communication like management letter. So what is management letter? You are giving a recommendations to the management. That is called management letter. For example, when we have conducted the audit of internal controls, right? You have identified certain design deficiency, certain operation deficiency, right? So, but those deficiency are not so significant to give any qualification in your report, right? So in that case of scenario, but they are important. So as of now, they might not be significant, they might not be severe, but if those design deficiency have not been improved, of those of operation deficiency has not been taken care, then in future it may result into a significant deficiency, right? In those case of scenario, you will be issuing a management letter, which is called recommendation letter to the management to help management in improvement in their process by identifying those design deficiency and operation deficiency and sharing your recommendation, what action management should take to close those deficiencies. That is called management letter, right? Make sense? What is management letter? Sometimes students get confused between management letter and management representation letter. What is management representation letter?
So
Sir, is
basically
management.
Sorry. Yeah, go ahead, please. Go ahead, please.
No problem, bro. You can go.
So basically, management representation letter is the auditor takes it on the like from management a declaration that all the information have been provided and it is correct.
All the information has been provided, like there is no, like
Yes,
all the information that is, related to the audit has been, given to the auditor by the management.
and they are true. Yes,
To my knowledge, sir, while conducting an audit, when
Mhm.
auditor has any query about anything, he asks the management to provide explanation like something, sir.
Mhm.
They give written representations to the auditor. So I think it may call management letters.
So maybe
I am saying, what is management representation letter?
So basically, that is a declaration from the management. So auditor takes from management that they have provided all the sufficient information required to perform the audit. So they
Yeah.
take it on their letterhead, although this is drafted by the auditor itself, but they take like a declaration for the management. They have provided all the sufficient information for audit.
Yeah. And how it
Plus,
is different
the
then? Yes,
Sorry?
Ankush. Ankush, go ahead.
Yeah, plus the management is responsible for the preparation of the financial statement and its disclosure. So basically, management representation letter is something asserting to that statement only that, yeah, you are responsible for the preparation of the financial statement. So management is confirming to the auditor, hey, we are responsible for the preparation of the financial statement. These are the facts we are confirming are true and true and fair, basically.
basically management representation letter is a letter which is issued by the audit party, like that is the client, to the auditor in writing as a part of audit evidence, as in certifying whatever the audit has been conducted. When the audit is being conducted, auditor finds out certain facts which it confirms from the management, and the management in that letter confirms all those things. That is basically what is the main content of the management representation letter.
Right. And how it is different from management letter,
How is it different from management letter?
which we have
So,
just discussed?
management letter would be different because in it would not be a part of audit. It would be a part of general representations if certain if management is giving to the auditor that these are the things as per which accounting policies are being made or whatever.
Good
Maybe
morning, Ayush. Good morning.
So management
What is
letter is,
management letter I just described?
so that is a recommendation from the auditor to the
Yes.
management.
Okay.
Good morning, Ayush. Okay, so how management letter is different than management representation letter? That's a question of the day.
So in the manage,
Yeah,
Yes,
Kashish, go ahead,
yes.
please.
yes, so in management letter, we will see that if there is any deficiency, like if there is a design deficiency or an operation deficiency, we will sharing our recommendations to the management, like
Yeah.
what has to be done.
That's true. Anyone else would like to add to
Yeah, I
Kashish?
think which we earlier mentioning that was management representation letter. I overlooked the word. So management letter is basically the recommendations from the auditor regarding the findings and the improvement in their internal control system, basically.
Yeah, that's true though. So why I'm emphasizing here, because like most of the time students get confused between management letter and management representation letter. So they look very similar, they sound very similar, but they both have like different objectives altogether, right? Next is SAD. What is SAD? Summary of adjusted difference. What is summary of adjusted difference? Any idea?
So the differences which are noted during audit and they have been adjusted already. So that is so basically corrected and uncorrected. No.
Yes,
So if you are
corrected misstatement.
adjusting, yeah, corrected misstatements are SADs.
Yes.
And if we talk from ICFR standpoint, SAD could be, I don't know whether we call it as a term, but while we perform in internal audit SOX, we call it aggregated summary of aggregated deficiencies as well. If
Yes.
you're talking from ICFR standpoint.
ICFR standpoint, absolutely right. And summary of unadjusted differences, which is still a disagreement between the management and auditor, right? That is called summary of unadjusted differences, which is not yet accounted for, not yet updated in the accounts. So that's a difference between like management and auditors. Next is SOX 205, confirming amendment of Security Exchange Act 1934. So whatever the new amendment comes in Security Exchange Act 1934 that's being applied to the respective firms and the companies as per SOX 205 section. 206 is conflict of interest. Conflict of interest means independence. So here 1 year cooling off period to audit the company in which CPA was CEO, CFO or officer. For example, let's say Rahul is a CEO of a company, let's say Tesla. So let's say Rahul is a CEO of Tesla, and let's say Ankush and Kashish has a CPA firm, and now Rahul in this year have joined Ankush and Kashish CPA firm and came to the practice profession, and he left the Tesla. So in immediate this year, he cannot do the audit of Tesla company, right? So there is a 1 year of cooling off period. For example, if any CEO, CFO or officer of any company is joining the CPA firm, that CPA firm cannot conduct the audit of that particular client in immediate that year. So there is at least 1 year of cooling off period mandatory, right? Next is SOX 207, mandatory rotation of registered public accounting firm. Controller General is required to conduct study and review of the potential effect of the mandatory rotation. But in US, like I said, the firm rotation is not mandatory. But Controller General can do the study and they can give the recommendation for change of audit firm, but it's not mandatory, right? 208, Commission Authority. It is unlawful to issue any audit report if the firm associated with the person engage in any activity which is prohibited under Section 10A of the Security Act 1934, issuer involved in illegal activity. So, like in our earlier class, we discussed Section 10A of the Security Exchange Act 1934. We discussed about Section 11. B also of 1933, so which says like the person is being involved in illegal activities. So that is also unlawful for conducting the audit of any such company, or if the auditor is being involved in illegal activity, that is also comes under the Commission's authority. 209, consideration by appropriate state regulatory authority for independence determination. They ask you to follow the independence rules of AICPA, right?